and India is buying it below the EU price cap, they say. Russia remains India's top oil supplier, accounting for 35% of imports. From January to June, India imported about 1.75 million barrels per day of Russian oil, up 1% from last year. However, some state refiners recently paused purchases due to reduced discounts, not political pressure. In China, the People's Bank of China, a PBOC, announced on Friday that it has set up a macro-prudential and financial stability committee to help defuse financial risks, pledging to maintain an accommodative policy stance. In its mid-year work summary, the central bank stated it will prioritize preventing and resolving major financial risks, supporting local government financing platforms in managing debts, and addressing risks in key regions and institutions in an orderly manner. The bank will continue to pursue an appropriately loose monetary policy in the second half of the year, using a variety of policy tools to maintain ample liquidity and guide financial institutions towards sustaining reasonable credit growth. Meanwhile, Xinhua reported that, as of the end of June, loans to the technology sector had risen 12.5% year-on-year, while lending to the green development and elderly care sector increased by 25.5% and 43% respectively. Meanwhile, Palestine economy recovers in the first quarter. The economy of Palestine expanded by 9.1% year-on-year in the first quarter of 2025, recovering from a 1% contraction in the previous three-month period. This marked the first growth in the economy since the third quarter of 2023, driven by increases in nearly all the economic activities, significantly in agriculture, forestry, and fishing at 26%, and wholesale and retail trades. Output also expanded in mining, manufacturing, electricity and water, information and communication, financial and insurance, services, and public administration and defense. On the other hand, contraction was recorded in construction at negative 5.8%. On a quarterly basis, the GDP shrank by 1% in the first quarter, the first decline in a year, reversing a 1.5% gain in the prior period due to the ongoing Israeli aggression and a 1.1% decrease in the West Bank economy. Meanwhile, European stocks rebound. European stock market began the week on a positive note, with a Euro Stock 50 rising 1.2% and a Stock 600 up 0.7%. The rebound comes after last week's sharp sell-off, driven by lingering concerns over U.S. economic resilience and global growth. Investors are now focused on the Bank of England's expected rate cuts and a busy week of corporate earnings and economic data across Europe. And now let's look at global stock market, what the price level and the changes taking place in the global stock market this afternoon. The global stock market. First we look at the stock market in Germany. The E40 price level standing at 27,714 euro per share, well upward by 288 basis points. In France, FR40. The stock market is upward by 54 points. Italian stock IT40 also gaining 639 basis points. A Spanish stock ES355 also are gaining this afternoon. Also, the Asian stocks have raised popularity, but let's look at the US stock then. A US 500 at a price level of 6,274 index level are gaining 36 points this morning. US 30, another US stock also gaining, and US 100, another US stock are gaining 170 basis points. The Japanese stock JP225 downward by 457 basis points, just like the Great Britain stock GB100 is gaining at 12 points this morning. A quick look at the markets as oil falls after OPEC Plus hike. WTI crude oil futures fell towards $66.5 per barrel today as traders digested OPEC Plus' decision to raise output and growing geopolitical uncertainty. The group confirmed a widely expected production increase of 547,000 barrels per day starting in September, completing the phased reversal of voluntary cuts made in 2023. While this move had been anticipated, it reinforced the expectation that global oil supply may outpace demand later this year, potentially boosting inventories. Uncertainty remains over whether OPEC Plus will pause further supply increases. Meanwhile, soft U.S. job data heightened concerns over a slowing economy, especially as the Trump administration's recent wave of tariff adds pressure. And now let's go to the market. First, and look at the commodity perspective of all the commodity markets. First, quickly looking at a commodity market and the prices regarding the energy and the different commodities. A crude oil price, U.S. crude, at $65 per barrel, falling by 1.38 points this afternoon. Brent, which represents Nigeria's price benchmark, also falling by 1.27 points this afternoon at a price level of $68 per barrel. Natural gas on a downward, gasoline downward, heating oil downward, gold price at $3,365 per ounce, gaining 2.68 points, just as silver also on the rise. For other commodities indicates the price of soybeans at $961 per bushel and wheat at $517 per bushel. And wheat gaining slightly, and while soybeans are dropping slightly, negative 0.05% decline. Coal price dropping 0.25 points this morning, and negative 0.22%. And we're talking about a steel price at $3,204 per Chinese yuan per ton, dropping 9 points this morning, and negative 0.28%. Still on world economy, Switzerland inflation rate is above forecast. Consumer prices in Switzerland rose 0.2% year-on-year in July 2025, slightly above market expectations of a 0.1% increase, following 0.1% rise in June and marking second consecutive month of inflation. Price increases were recorded in restaurants and hotels, clothing and footwear, housing and energy, as well as communication and recreation and culture. A multiple observation indicates that prices fell for food and transport, as well as furnishing and healthcare. A higher cost for private transport, hotels and supplementary accommodation were offset by declines in prices for a package holiday abroad, as well as clothing and footwear. Quickly, let's look at the charts indicating Switzerland's inflation rates this afternoon. The charts. A chart indicating Switzerland inflation rate has been on a descending order from last year, July. Price level standing at 3.3% began to drop and drop consistently until April, getting to a point of probably deflation in May, where the prices were totally low, and from June, prices began to go up a bit, 0.1% and 0.7%, but still indicating stability in terms of the cost of commodities in the country, and talking about the currency of the country being quite good and stable. Still looking at European economies, Spain jobless fall less than anticipated. The number of people registering as jobless in Spain declined by 1,357 or 0.1% from a month earlier to 2.4% in July 2025, the lowest level since June 2008. Analysts had expected a reduction of 21,300 people. Compared to June, unemployment fell in the agricultural sector by 614 people, that is a negative 0.8%. Conversely, unemployment increased in construction, industry, and services. Meanwhile, the number of people previously unemployed also declined by 3,315. Unemployment among young people under 25 fell by 2,561 in July compared to the previous month, bringing the total to 164,146, the lowest figure ever recorded for this group. The total number of unemployed people declined across 6 regions, with the largest decreases recorded in Andalusia, Castilla-La Mancha, and the Principality of Asturias. Still in Europe, looking at Europe's population predicament. Fertility rates have fallen and stagnated across Europe. By 1980, most countries in Europe had already fallen below the replacement threshold. Now, every single European nation is below the threshold, and various reasons have been proposed for this vast decline in fertility, such as the availability of contraception and the increase of women in the workplace. However, the fact that sperm levels have more than halved over a recent 40-year period may be central to this sudden decline. And now let's look at the fertility rate in European countries from 1970 to 2025. Countries such as Spain have seen their fertility rate more than half from 1970 to 2025. One projection sees Spain's population decline by a staggering 50% or more by the end of this century. For countries such as the UK, only mass immigration into the health and care industries has kept its population stable. One estimates argues that to sustain this policy, nearly half the century. These falling fertility rates will lead to the depopulation of native demographics through the following decades. One projection sees a 49 million person shrinkage in the working age population of the EU. This will create a top-heavy generational pyramid which will naturally put great strain on healthcare and old age support systems. Hungary, where rate has fallen by a quarter from 1970 to 2025, is expected to spend as much as 5% of its GDP on pro-natal policies in the future to reverse such trends. However, government initiatives attempting to increase fertility rate, such as subsidized childcare, will be largely ineffective in the future, according to the latest research. And now looking at Turkey's inflation as it slows to 33.5% in July. Turkey's annual inflation rate eased to 33.52% in July 2025 from 35.05% in June, coming in below market expectations of 34.05%. This marked the 14th consecutive month of slowing consumer inflation and in categories, particularly in food and non-alcoholic beverages, housing and utilities, and transports. As you're looking at the indices, inflation also cooled in clothing and footwear, household furnishing and maintenance, hotels, cafes and restaurants, as well as health services. And now let's look at the charts indicating Turkey's inflation rates. The charts this morning. Inflation in Turkey has been on the descendancy, dropping slow and steady. Well, as at last year, July, inflation in Turkey was standing at 61.78%. A continuous slowdown in that regard kept going down until February, and then March and April this year at 17.86%, dropped even further to 35.41%, dropped to 37, and then downward and downward to 35.41%, and currently at 31.52%. Indicating continuous drop in terms of prices of commodity in Turkey, as well as the strength of the Turkish lira. And now we'll go on a quick break, and when we're back, a world economy continues looking at different incentives, and one of the conversation would center around Ireland, that Ireland is now significantly wealthier than the UK. We'll talk about it when we're back from the break. Don't go away. Welcome back. It's World Economy, and my name is Vladimir Kim. And as you're looking at a perspective of economy, looking at two countries or two nations, Ireland is now significantly wealthier than the UK. Once upon a time, about a century ago, Belfast was bigger than Dublin, and industrial Northern Ireland was much wealthier than the poor agricultural South. Today the roles are reversed. Northern Ireland remains, to a considerable extent, dependent on handouts from London, and is much poorer than prosperous Ireland. Dublin is now 3 times the size of Belfast and looks, unlike Belfast, like a thriving European city. A union with Britain doesn't seem to have worked so well for the Northern Ireland nation. Or Northern Ireland, yeah. Not Ireland, but Ireland. I mean, while UK and Irish GDP growth over the past 25 years would be what we're looking at, Let's look at the table, the chart indicating UK and Irish GDP growth over the past 25 years. One reason often cited for the dramatic change, as you can see, is the attraction of the Irish low tax regime for major US multinationals. However, the UK itself is often associated with tax haven status, according to Channels Island and British Virgin Islands Spring, a two mine, and not to mention the London Laundromat. In recent years, since 2016, the considerable divergence in GDP per capita growth in favor of Ireland, as we can see, it's more likely explained by the Brexit vote of that year, with Ireland now a more favoured route into the EU than the more isolated United Kingdom. David McWilliam, a notable Irish economist, wrote recently, "The truth is the union with Britain has been an economic calamity for Northern Ireland, that is Dublin, Ireland." Looking at GDP and GDP per capita data, this summary is not easy to refute, as we see on the chart as the standing is, indicating the divergence between Britain in having that red line, United Kingdom with the red line, and Republic of Ireland, a position in the Northern Ireland with the green line, showing the growth of Dublin and Republic of Ireland. A bit back to Africa, we'll be looking at the top 10 African countries with the weakest currencies in July 2025. A weak currency can significantly deter economic stability and growth prospects in African countries as the world becomes more of a global village. Although exports may occasionally become more competitive due to currency depreciation, prolonged currency weakness can have very negative long-term effects, particularly for countries that rely significantly on imports, external debt, and foreign investments. Inflation is one of the most direct consequences of a weak currency. Fuel, medicine, machinery, and food are among the essential things that many African countries import. The cost of these import prices as the local currency weakens compared to the dollar or euro, raising prices for both consumers and companies. And 2025, this list is courtesy of the Forbes currency calculator, as Sao Tome and Principe ranks number 1 on the list. Well, quite a sad story. Sao Tome and Principe number U is 22,281 Sao Tome and Principe Dobra against the US dollar. Number 2 is Sierra Leone, 20,969 Sierra Leone leone against the US dollar. Guinea at number 3, 8,676 Guinean franc against the US dollar. Uganda at number 4, 3,588 Ugandan shilling against the US dollar. Burundi at number 5, number 6 Democratic Republic of Congo. Tanzania at number 7, Malawi at number 8, number 9 Nigeria at 1,531 naira to the US dollar, and Rwanda at 1,445 Rwandan currency against the US dollar. And now let's go to the financial market, FX market, as Swiss franc falls as US tariff overshadow inflation uptick. The Swiss franc weakened to around 0.81 per US dollar as concerns over newly announced US tariff overshadowed a modest uptick in Swiss inflation. On August 1st, the Trump administration unveiled a 39% tariff on Swiss exports, higher than the 31% rate announced in April, with the measure set to take effect on August 7th. If sustained, the tariff are expected to reinforce disinflationary pressures in Switzerland. Meanwhile, inflation rose slightly to 0.2%, as we said it earlier, a year over year in July, above expectations of 0.1%, but still hovering near zero. And now let's go to the market, looking at the FX market as we set to close. The FX market this morning. FX market began with the euro against the US dollar at 1.15 points mark, a slight decline for the euro against the US dollar, negative 0.05%. The pound against the US dollar, 1.33 point mark, the pound gaining 0.2% over the US dollar. Well, we'll move further and look at a New Zealand dollar gaining 0.23% over the US dollar, and the US dollar falling against the Japanese yen, JPY, a 0.102 points drop in that direction. And the Swiss franc at the bottom of it against the US dollar, the Swiss franc suffering as the US dollar again 0.38% over over the Swiss franc. Let's look at further currencies. Well, the Mexican peso, as you can see, 18 Mexican peso equaling $1. The dollar falling 0.36% against the Mexican peso. The Indian rupee, 87 rupee equaling $1, a dollar gaining 0.54%. At the Brazilian real at 5.52 real against the US dollar. The US dollar falling by 0.29% against the Brazilian real. And the Russian ruble, a US dollar against the Russian ruble, 79 Russian ruble against equaling $1. The dollar falling by 0.72% against the ruble. And the South Korean won, the dollar falling negative 0.49% against the South Korean won, and the dollar index falling by 0.49%. And it's a story regarding the market, and the bottom of it is a Turkish lira in that direction. Here we draw the curtain in today's edition of World Economy. Thank you for being a part of it. All the angles being looked at on world economy. My name is Vlad Kim. Thank you for being a part of it. Return some for further outlook of world businesses. Don't go. Take a wonderful time and have a pleasure looking at other programs we have for you.